Splendid evening it is to viewers. Welcome to Equity News on Equity Access, your aerial perspective of stock market developments and of developments in the Zimbabwean economy. Thank you for joining us as a broadcast from Hampton Studios. I'm Ibn Mabunda. Let's get on to business. Renowned economist Eddie Cross, who was a parliamentary chair on public accounts for a decade, says austerity is a necessary economic policy that has so far yielded results for Zimbabwe. He says notably when RBZ delinked the US dollar from the RTGS or dollar or bond currencies, we held about $200 million in private Nostro accounts. Today we are approaching the $1 billion mark. He also commenced the creation of the Interbank market system for foreign currencies, and this has started to function and attract foreign exchange balances. Well, this is what he's actually making reference to when he speaks about fiscal consolidation. If we look at October here, November, we were actually in a trade. We were actually in a deficit. But since then, there has been fiscal consolidation. December, January, moving right up to February as the trend actually continues. So, government has actually recorded a surplus ever since December of 2018. So, these are some of the positives that Eddie Cross has actually made reference to. However, he said that the real answer would be the removal of government's hand in the economy, and he advocated for the introduction of a real market economy across the board. Well, in a recent tweet through its official account, the IMF says it will support the country by monitoring the staff monitored program for Zimbabwe, covering the period from the 15th of March right up to the 15th of March 2020. The IMF also raised a red flag over government's continued loan acquisitions, which are securitized by local mining resources. This is the tweet through the IMF Twitter account. It says, Zimbabwe's comprehensive reform program aims to address its economic challenges. IMF staff will support the country by monitoring the implementation of the program. In other news, JSE-listed chrome and PGMs producer Tharisa has commenced mining operations at its Salene chrome project here in Zimbabwe. This follows approval by the Environmental Mining Agency. London-listed Standard Chartered Bank today announced its plan to establish a foreign exchange e-trading and pricing engine in Singapore with support from the Monetary Authority of Singapore. The launch of this trading platform is set for the first quarter of 2020, and the platform is expected to see the trading of 130 currencies across the world, as well as 5,000 currency pairs. This is according to the report given by Standard Bank. Meanwhile, President of Nigeria, Muhammad Buhari, has commended Ecobank for its engagement in the Nigerian SMEs following the investment of Ecobank of an amount to the tune of $150 million over the past 6 months in Nigeria's SME sector. This concludes our evening news bulletin. More to follow in our stock market review. Please stay tuned. Welcome back, viewers. It's now time for news review, and with me on set is our very own chief analyst, Respect Quincy. Respect, good evening and welcome to the show.
It's always my pleasure. Thank you, Eben.
Fantastic. Now, to get the ball rolling, Eddie Cross says, look, Zimbabwe is actually on a positive trajectory, and he says, among other things, we've been able to achieve fiscal consolidation. We've also seen an increase in terms of the balances that are reflecting in the accounts of the citizens, from about $200 million to just below $1 billion. What is your assessment of the sentiments that Eddie Cross has shared?
There are clearly two aspects with regards to what you have referred to as part of his statements. There has been a growth in terms of in terms of sentiment coming from those who are exporting, those who are holding forex reserves in Zimbabwe. So since October of 2018, when accounts were split between the USDs and the RTGS Nostro and FCA Nostro, there has been that growth between from 200 to 1 billion. This is basically a sign of confidence. If you are able to split currencies between local and foreign, then that means there is clarity in terms of currency. There's also clarity in terms of what you own that is actually security. So it actually increased confidence in the market, and that's clearly a positive. What has not come after following that is we haven't seen that money now propelling into the interbank market, which is what we need if we are to obviously try to push transactions via the interbank market. So despite this growth in terms of holdings via FCAs and Nostro FCAs, we haven't yet seen pure trades from this $1 billion money into the real interbank market. That's because the market itself is not fully liberalized, and of course there has been a wider variance to that market as well, and the black market as well. So the exporters feel that they might not get full value of their money, given that there's a wider disparity between the official exchange rate and the exchange rate that is coming from the parallel market. And so obviously that's one of the issues there. But I think I agree with him. There has been an increased confidence because of the split in accounts. But coming to the issue of fiscal consolidation, I think I hold a view which many do not quite share. There is a clear, there's almost one mind or maybe an agreement that the economy is moving in the right direction in terms of how the fiscal position stands at. Over the first 3 months of the year, we've managed to post a fiscal surplus with respect to our national accounts, and the numbers are clearly showing here. Just for January and February, we are almost sitting at almost 200 million in terms of the surplus. But I think for the 3 months, the figure is somewhat around 300 million, which is also a positive. But what's notable here going forward from that period onwards, I think we have to look at the paper which Mutuli presented to Parliament a few weeks ago. In that paper, he highlighted that in the second half, there's going to be an increased expenditure, and that expenditure is going to move our budget from the initial target of 8 billion to about 12 billion. And obviously, given that we are now projecting revenues to clock in something around 9 billion, it means the deficit position is also equally going up. So all in all, if that comes to fruition, it means we will have a deficit position of just about 3 billion thereabout, from an initial projected deficit of just about $1 billion. So by implication, that raises the budget deficit position at full year, if his numbers are anything to go by. So when the deficit position goes up, looking at the projected full year numbers, it simply means we are now wide off the TSP level, because TSP is about reforms, but not just reforms, but fiscal consolidation as well as current account consolidation as well. So you have to minimize your deficit to GDP ratio. You also have to minimize your current account to GDP ratios. Those ratios are now targeted. They were targeted to perform just about 5% at 5% levels, which is 5% of GDP becoming your deficit. Those are the international standards. If you have your GDP, your budget deficit to GDP levels at 5% and your current account to GDP of 5%, then that means the economy might be manageable going forward. So what's worrying now is this increase, or this revised budget, which now sits at around 12 billion, and which will result in a deficit of about 3 billion. the question now becomes what to fund this deficit. So if you're projecting a deficit position of 3 billion, definitely that means it will have to be funded by quasi-fiscal, it has to be funded by treasury bills, which has been the norm over the past few years. Why? Because government does not have a leeway to borrow outside. So in as much as many are concluding that the TSP or the 2-year TSP is on the right track because of what you have achieved, notably on the fiscal consolidation side, I don't believe it is sustainable. Let me try to elaborate. What is going to happen as we are getting into the second half? Costs have already adjusted. We have seen civil servants being offered, they are going to be offered another salary increment above the initial 10% cushioning allowance which they were given earlier in the year. We are likely to see their salaries being increased by anything between 30 to 50%, and that obviously is a cost to the fiscus. We have also seen producers, the prices being subsidized in terms of in relation to various crops, and that also is a pressure, puts more pressure to the fiscus. Government has also much of the infrastructure deals will have to be revised in line with the new RTGS cost, which was not reflected in the initial budget. So obviously all that will definitely push the net costs of the net budget up. And all this thing about fiscal consolidation, it's about your expenditure living within your means or your revenues. So if you see a wide difference between your budget and your revenue, then that causes what's called a deficit. And it's about how you manage this deficit, or how you limit it and how you fund it. And this deficit in terms of ZIM is obviously going to be funded by treasury bills. So that's where my problem is that we are not looking forward. And now, I think one other aspect which generality have find solace in is the fact that by virtue of having changed currency, therefore a GDP which was projected to be at 24 billion is now projected to be somewhat around 70 billion, which is simply a multiplication of the current of the initial USD kind of GDP level multiplied by the Interbank rate. I don't know whether it was 2.7 or 3 thereabout to give us the current level. So if you then divide what you call the budget deficit of 3 into 70, the figure is almost negligible. I think it as a percentage it's almost negligible. That's what's giving comfort to government at the present moment. But I don't feel that there's a clear computation in terms of how we are arriving at our our deficit to GDP level, which in my terms would mean that our deficit is not manageable. Because if you're using that computation, which is being used by others, it would show you that government can easily manage that deficit position, but that's not my own view. So around the TSP, I think there are a lot of points that the generality is missing. If you're looking at the current account as well, over the first 3 months, our budget deficit is looking quite narrower. Compared to last year, we've fared fairly well relative to the past year. And I think we are almost at the 2017 levels. In 2017, we did a net deficit of about 1.7 billion in terms of our net foreign positions, in terms of our exports and imports. And that was quite manageable, but it's coming at a huge expense. We have to cut. We have to cut electricity. We have to cut electricity imports, and by implication, we're also stopping production. We have to cut fuel, petrol and diesel imports, and by implication, we're cutting production as well, because most people have to revise and most people have to find alternative forms of energy. And if I may tell you, ZIM is now predominantly an informal economy. I visited one of the suburbs, the ghettos yesterday, and this is a 500 man-manned workshop where they do sewing, micro sewing for uniforms, and around 10 a.m. electricity just went out, and these were 500 people doing their normal work schedule around sewing activities. And you can just imagine the implication of having to lose, of electricity just going out, in the middle of production. So it just shows you what the nation is losing in terms of revenue. But on the other hand, we are also gaining in terms of reduced imports, which then gives us possibly a low trade deficit position. So, I think when you look at the cost to benefit, it's better for us to produce, but to produce the net impact should be increased production, but that production should give us more value. Better than what we are foregoing in order for us to produce.
Could then austerity be perhaps leading us into a technical recession somewhat?
It's quite a given. Our 2019 position in terms of economic growth is going to be negative, which means we are obviously going into a recession. I think at the end of the tunnel, what's more important is not to look at the short term. I think what's more important is for us to look at the mid to long term prospects of the economy. So my own thinking is that it's about how government is going to manage the current crisis. If there are exchange rate headwinds, if there are prices, inflation headwinds, and there's obviously a dip in production, interest rates management, and so forth, if government fails to contain these variables, then it means austerity may not come out in the positive. And my own indication is that some of these aggregates are already going out of hand. If you look at the way prices are running, even though there is sentiment running in the market that obviously prices on the parallel market are not sustainable at the current levels, what I also believe is that within that lag time, there's obviously a cost impact. So you cannot just say, if fundamentals are showing me that the exchange rate should be 1:4, if it's running at 1.9, then I won't buy. Government has day-to-day chores that they have to feed in, they have to pay for, and they'll definitely have to pay more, even though their own numbers are telling them that these are the fundamentals will not support a price of that much. So it's about how they manage this volatility, how they manage the issues to do with interest rates. Because for every banker in town right now, it's not rational to keep on lending at the current lending rates. So by implication, it means you have to stop. You have to lay back in terms of extending credit to the private sector. And by implication, you are also stopping production. That is, if people are borrowing to produce, and if you are to look at other aggregates like inflation, then that means consumption will also go down. People will buy less, and so forth. So all these things have to be managed, even though it's in the short term. It's about how you manage them in the short term, which will determine your long-run success. So obviously, confidence is a missing link. Fundamentals, I think government is in a position where it can no longer sell something that the generality can easily buy. So it remains to be seen where that stability, which they purport to be coming, will come at. But in the very meantime, in the very short term, there's obviously a cost associated to all these activities. So generally, I don't believe in the view that the economy is on the right direction. I do not believe that the transitional stabilization plan is on right track. I applaud the reforms. I applaud what government has done in terms of obviously on the law side, bringing in a lot of changes to some of the hindrances before that were stopping investment. But I don't agree in terms of how, in terms of the tools that are being managed to drive the economy in the right direction in terms of fiscal consolidation and even on the monetary side as well.
Okay, now Eddie Cross again also said that it's high time government steps out of the fuel scenes, electricity and all that, and allow market forces actually get to run the show. Do you agree with that?
I think government has been gradual in doing so. It has come at a cost, but some of these things, they are easier said than done. So if you are sitting in government's position, you are also worried about the short-term volatilities that might come. If you liberalize a certain market, there might be pandemonium in the economy. There might be obviously there might be a serious uprising. You know the January effect when fuel prices went up. So some of these things, government obviously had to put have to try to moderate the impact. So in as much as you are pulling back in a certain industry, you also still have to contain certain levers in terms of how, I think this whole exercise has been phased in a way, and I want to believe we are almost in the third of 4 layers where we have to undergo, and I believe that we are obviously moving towards the liberalization of the fuel market, but I think government has been, the way that they have liberalized those markets has been gradual. Of course, it comes at a cost, but I think it's quite fair.
Well, thank you, Respect, for the perspectives. Thank you, viewers, for staying with us. Please don't go anywhere. Up next is a look at the stock markets.
Good evening, ladies and gentlemen. This is Markets Daily on Equity Access. My name is Anis Chimbumu. Joining me here today is our Chief Analyst, Respect Gwenzi. Respect, how are you doing today?
I'm doing just good. Anis, yourself?
I'm all right. Now, just to cut to the chase. The market did have a very bad close last week. 2 sessions in a row in the negative, cutting short a 34-day run in the positive. Now, today, then resuscitated itself, coming back, but with a little bit of a weak gain there, with the most dominant index actually in the prior sessions coming up a little bit by about 0.08%, showing that it didn't have much influence in today's positive outturn. Now, the all-share index did go up 0.37%, while the industrials index did come up 0.35%. Mining's index still is very bullish, coming up 1.4%, 4 days running now, and then it has now come back into the green on a year-to-date basis.
I agree. The market has obviously been on a very long bull run. I mean, stretching 34 sessions and coming off a bit late last week. But I think that was mainly a profit-taking issue where investors had to clean off a bit from their investments after a very solid run. But the background is always that last week we saw the liberalization of the interbank market, which obviously drove investors into hedge-seeking moves, and I mean, they accumulated stocks, mainly the top-tier stocks. We saw Delta, Cassava, Econet, I mean, accruing gains in the past week. And today's gains are very marginal. They're definitely in the very average levels. This is where we'd expect a normal day to look like, given a rise in the stock market. So that shows you that the prior week gains of 3 to 4% a session were definitely invoked by a reaction to the interbank market. And obviously counters like Delta up 0.26, and also InScore as well as Old Mutual, they're consolidating their positions, and growth in Old Mutual, it obviously widens the OMIR rate, the Old Mutual implied rate. So I believe that we're still in that period where we are likely to see another consolidation. I believe last week stocks were taking just a minor breather, but from my own perspective, we are still in there for the long. For the long haul. And what happened last week was basically creaming off of gains that had been accrued. In a very short space of time. Stocks going over 20% in just under a week.
All right, that's a very good analysis there. But today's market only had about 21 counters that exchanged hands. 17 of those, actually 13 of those were in the green. 4 were losers, leaving the remaining at a stable rate. Now, on a week-to-date basis, these indices do show some improvements, but if we just look closer to what happened actually as to the bulls and the bears that pushed the market up today, Zimbabwe Holdings was up 20%. Okay, did trail that, coming up 11.11% for it set at 50 cents, while banking stock ZB Financial Holdings was up 8.51%. Now, a little bit more of an interesting issue for me today has much to do with Cassava, which was one of the fallers. did shed off 0.07%.
So it means it sustained Friday's losses?
Yes, it did. Now, Cassava has one of its companies under that group, which is Steward Bank, and the head of that banking division, Lance Mambondiani, did mention that he's going to be resigning. Any insights from you? Where do you think it would take Steward Bank? Who is probably going to be coming in? Is that going to shake up any investor confidence?
I don't have as much insight. In fact, I don't have insider information that might be valuable out there. But for perspective purposes, I believe if you look at how Cassava is structured, the bank, which is Steward Bank, which processes the transaction, is actually at the center of what happens to EcoCash, which has been one of the phenomenal products in the market, 98% market share, running into billions in terms of volume of transaction. I mean, in over a very short space of time. So the bank has emerged as one of the strongest in terms of non-funded income. If you look at their non-funded income, which is mainly from fee and commission, it is the highest in the market, ahead of everyone else, and that has propelled the bank into the top 5 banks in Zimbabwe. And the growth has been driven by the tendency towards tech solutions, which of course have got a seamless relationship with what happens at EcoCash as well. So the bank has been growing phenomenally. He joined the bank 6 years ago and is leaving it at a position where it's actually strong. It has a strong team in terms of their IT. They've got a dedicated IT department, and it also has got some tech guys who are mainly into innovation of products, and they've been coming up with most of these market-shaking products over the past few years. So I think the bank is strong in terms of its fundamentals. They obviously have to increase their exposure in terms of funded income, which has been one of the issues that they had with the regulator over the past few years, to say your income is now predominantly on the non-funded side. You now have to obviously have a balance. But I think Mambondiani, I mean, he led the group well. Of course, there are bound to be issues as you progress, but obviously he's not leaving the bank on a good note. The Econet as a group has said no, he's leaving the group. I mean, in terms of he's leaving the group on fair terms. They said on fair terms, okay. But obviously, I mean, in the corporate world, most of these things they are obviously packaged in a way so that they give a good name to the person who is leaving, and they also give a good name to the company as well. I mean, so that you have an amicable. Yes, but he was really a good manager. If I mean, this kind of growth, of course, it leveraged much in terms of ICT, which Econet funded, but I also believe he had something in him. His credentials are there for all to see, and obviously he still has got a brighter future.
Yes, because I think I do really agree with you that he really hit his bank more on the ICT side, which has pretty much paved the way for the future of banking in Zimbabwe. Already we are in a very cash-strung society, and that solution was the only solution for us to still be able to transact and exchange goods and services.
So basically, I think I still see a future in terms of how the bank is going to roll out more products, and obviously that's gonna spill over to Cassava as well. So I think it's still quite an intact investment, and they're still going to roll out some more products to the market. And so obviously that slide debt is a continuation of last week's decimation, which is basically a profit-taking move, and I still feel that the company is quite solid.
All right. No, maybe just a quick rundown. South Africa was the weakest performing counter, letting up about 9.5%, while African Sun and Axia trailed that, coming off 6.98%.
So I think this is basically a continuation as well of profit-taking. If you saw on the past week, South Africa was one of those top performing counters.
Yes, it did.
It reached a max of 2, but it has been trading on an average of about 1.5 over the past 1 to 2 years. African Sun as well has enjoyed a very good rally, gaining more than 40% over the past few weeks as well, together with another PA in that same category, which is RTG. But I think it's also an issue to do with profit taking, and I think that's the market trend generally.
All right, thank you for those insights. If we just have a quick look into our forex market, the parallel market rate has settled today at 7.5, while the interbank rate has continued on its weakening path to about 5.42 today, and the interbank in the all mutual implied rate is at 9.68. Do we see a continued run? I mean, the government has continued on its borrowing spree. There's no secret to that. They are talking about wage increases for most of their.
Yeah, I think in terms of sentiment, the market is not yet at par with what government is communicating.
Mm-hmm.
A lot of advocates from government is pointing to the fact that the interbank rate has to come off a bit. They believe that the market has to stabilize at around 3.5 thereabout. I mean, based on the demand and supply forces, but that's holding constant the fact that you are not likely to borrow, because if you borrow, then that increases money supply in the economy, and that increases transferable deposits as well. Mm-hmm. So if there is that view that government might get to a point of borrowing to sustain what is obviously likely to be a huge deficit. I mean, if you're sitting at a deficit of more than 3 billion, it's obviously ahead of last year, and that has to be funded by other sources such as treasury bills, and that feeds into money supply as well. So I think, obviously, even from an elementary view, it's an aspect to do with confidence. There's no confidence in the system, and it's hard to sell the point. It's hard to sell a point that we have stabilized the books, so we are likely to maintain it. I think if we are going to possibly see a budget surplus being maintained over at least a 1-year period, then Zimbabweans might start to come to terms with the fact that the current administration is true in terms of its view to balance its books. It's also true to its idea of trying to balance the current account as well. That obviously ensures that we have a minimal budget deficit and a minimum as well trade deficit, which ensures that there's current stability, and it also ensures that there's minimum growth in terms of money supply. So I think it's still a long way to go. You don't earn goodwill over a day. You have to run over a longer period. But as you get into the second half, there's also that danger that we are likely to borrow more. Why? Because the same government has revised its books as well. So obviously that might obviously increase its borrowing spree, treasury bills, and transferable deposits in the economy. So the rate, obviously, in the very short term, it has to keep on going up. There's been a serious backlog as well, and so we're likely to see the rate even going upwards, maybe to around 6 on the official exchange rate, and maybe even a price of about 8 to 9 in terms of the parallel exchange rate, before we can really talk about any stabilization. But a stabilization of 3 to 4, in my view, is quite conservative. I think it might go up to 6 thereabout.
Yeah, I think I would agree with you there. I mean, there is not much efforts as to the fiscal consolidation that truly is really looking forward to. I mean, he keeps bloating money supply, and that should only make that white elephant a lot more elusive. Now, I think with those dynamics in play, the economy is going to only then find itself trying to re-dollarize. I mean, there are a lot of businesses that currently have already started stating their prices in US dollars.
So that puts a premium on the local money. It actually keeps on pushing. And I also don't believe in the valuation of saying fundamentals are saying 3:2. I mean, that they're saying the maximum value can be 4. That is, if you divide the 1.8 billion against a certain rate, then obviously all the money is gone. You know, we are rational human beings. Whenever we anticipate risk, we put a premium so as to cushion ourselves. So if you know that there is likely to be a depletion of value, then you obviously put a premium in terms of the money that you're holding, be it USD or any other currency, so as to hedge the risk of, you're putting a premium so as to hedge against the risk of losing that extra currency. So if the true rate is 1:4, then I might be putting myself at 6, so that if the rate goes up, then I know that I've got a leeway of at least +2 in terms of points terms that I can cushion myself. So I don't believe that human beings are as irrational as just concluding that a rate is at a certain level simply because money supply is this and the rates are, and the forex in the economy is this.
Well, it is only just a matter of time as the economy continues to crash. From me and the Equity Access team, do not forget to like, subscribe, and follow our YouTube, Twitter, Facebook, and Twitter accounts. Yes, at Equity Access.